It is compulsory for the receiver to accept it. But no, government doesn't declare this as a legal tender, as a mode of a transaction. You can pay it, right? If the acceptor accepts it, if he has very high confidence on this, he will accept it. And if he doesn't have the confidence, he might simply say, sorry sir, I will not accept the payment, let's say in the form of a check. Please use other modes of the payment as such. So one is this feature. The value depends on the confidence shown by the acceptor in the market. And generally what happens? Have a look at this. Imagine you will come to the shop that I own. You will purchase certain goods. You will make a payment in the form of, let's say, a check worth 2 lakh rupees. Is it okay? 2 lakh rupees. Now what I'll do? I'll take the check, go to a bank, deposit the check, and given fiat money. Is it okay? I will be given fiat money. So fiduciary money or a bank money is issued by an authority or an institution, the value of which depends in the market based on the confidence that the acceptor has on this particular money. And once the acceptor accepts this particular money, he will go to the issuer, submit it, and he will be getting the fiat money. The best example for this is a check and a demand draft. Done. This is a fiduciary money. And the last type of money, commercial bank money. Okay, commercial bank money. Now, in case of a commercial bank money, understand this. This is the amount of a credit or amount of a debt that is created by the banking sector. I'll repeat the statement here. Commercial bank money is the money in the form of a credit or in the form of a debt that is created by the banks, which use a concept called as a fractional reserve system. I'll explain this. Give me a minute. And it is a debt which is generated by the banks, which will be exchanged for money in the system. What do you mean by this? Let me start here. Understand the concept here. I'm talking about fractional reserve system. Fractional reserve system. Now, what is this fractional reserve system? I'll use the short form henceforth, FRES. Under fractional reserve system, which is followed up by banking sector in India, what generally they do is they will accept the deposits from different customers. They will basically take these particular deposits, keep a fraction of these particular deposits right on the side, and use the remaining to give loans in the system. I'll repeat the statement here. The deposits are collected by the bank. Part of the deposits are maintained as reserves, and remaining amount is utilized to lend in the market. And when you talk about the concept of lending, I've got to understand this. When you talk about the concept of a lending, it is nothing but the debt that is getting created in the system. The money that is getting created, money is not printed, money is getting created in the system. Means what? Before I discuss here, let me give a very simple example. Imagine you have 100 rupees. Okay, you have 100 rupees. So how much note is printed by RBI? Let's assume only one note, 100 rupee, and you have it. So imagine you have that particular 100 rupee note. Now, how much money is printed by RBI? Only 100. But what you will do? You will give that 100 rupees as a loan to me. Is it okay? You will give that particular 100 rupees as a loan to me. Now, on paper, you have, right, 100 rupees. Is it okay? Because obviously I'll have to give that 100 rupees back to you. You have 100 rupees. And now I also have 100 rupees, which I will use it to purchase goods and services in the market. Now, what is happening in the system? The debt is getting created. The loans are getting created. Money is not getting printed. I can understand this. 100 rupee printed. You had 100 rupee. You will give that as a loan to me. Now I will give it back to you. So anyways, you will receive the 100. But using the 100 that I have borrowed from you, I will start purchasing goods and services in the market. So we are creating credit. We are creating debt in the market, right, as a result of the lending activity. Now, what happens in a bank? Please understand. I'll start with the same example. Imagine RBI has printed 100 rupee note and it has come to you. You have this particular 100 rupee. Now you will take this particular 100 rupee, go to the first bank. I'll write it as B1. Go to the first bank and deposit the 100 rupee in the bank, either in the form of a recurring deposit, fixed deposit, savings bank account. Do not worry about it. You will keep the 100 rupees with the bank. So 100 rupee which was printed by RBI has come into banking sector. Now the banks are supposed to maintain certain reserves. Is it okay? Banks are supposed to maintain certain reserves. We'll discuss about this. There are two ratios. One is called as a CRR and the second one is called as SLR. Is it okay? One, CRR, do not worry about it. There is a separate slide on this. We'll discuss it later. One is CRR and the other one is SLR. Let's assume both of them put together is 10%. Is it okay? Both of them put together is 10%. Reserve ratio, let's assume it is 10%. So what will happen? When the reserve ratio is 10%, bank has received 100 rupees. It has to keep aside a reserve of 10 rupee because there is a reserve ratio. It has to keep aside 10 rupee and remaining 90 rupee. What do you think the bank will do? It will give it in the form of a loan. Is it okay? It will give it in the form of a loan. That is the first step. Now imagine you are the person who has deposited 100 and I am the person who has taken a loan of 90 rupees from the bank. And let's assume I am a manufacturer. So this particular 90 rupees as a loan has been given to me. What will I do with the loan of 90? I will go to market, start purchasing raw materials, start purchasing machines, etc. So have a look at this. I will take the 90 rupees, go to market, purchase, let's say, a machine. And when I purchase a machine, I will give 90 rupees to the seller. Now the seller, he will take the 90 rupees, go to the second bank and deposit the 90 rupees in the bank. I can understand this. Money is getting created. Notes are not getting printed here. Only same 100 rupee note gets circulated again and again like this. So 90 rupees comes to the second bank. What will the second bank do with this particular 90 rupees? Again, keep aside a reserve of 9 rupee. And how much is left out? 81 rupees left out. They will give it as a loan to, let's say, a farmer. Now the farmer will take 81 rupees, go to the market and let's say purchase a fertilizer, purchase a irrigation equipment and make the payment of 81 rupees. And what do you think will happen to 81? Again, the 81 will come and fall into the third bank. The calculation will continue. Don't worry about the calculation. Calculation will continue. But the idea simply is the currency notes which are printed and issued by RBI are used by the banking sector to create a credit, to create a debt in the market. That kind of a money is called as a commercial bank money. Is it okay? That kind of a money is called as commercial bank money. And because we follow a system called as a fractional reserve system, the debt gets created in the system like this. They are not printing notes. Understand this very carefully. They are not printing notes. They are in fact using the same notes which are printed by RBI to create credit in the system, to create a debt in the system. This kind of a money is called as a commercial bank money. Done? Again, we'll be using this particular system when I discuss the monetary aggregates. Please remember this. Okay, so these are the four types of money. Quickly again, one is a commodity money, right? Has a very high intrinsic value, and the intrinsic value will determine what is the mode of exchange, what is the value given in the market. In case of fiat money, government issues an order, has no intrinsic value. Because the government gives an order, the value will be provided to the money. Best example, currency notes, currency coins in India. Third one is a fiduciary money or a bank money, which are issued by the bank and let's say financial institutions. The value of this depends on the confidence shown by the acceptor in the market. Acceptor will receive this particular fiduciary money, go to the issuer, submit it, and in return is given the fiat money. Okay. And finally, commercial bank money. The banks, right, will use the money that is printed and distributed by RBI present in the system. and keeping certain amount of reserves on the side will keep on creating credit, will keep on creating debt in the market. That is called as commercial bank money. Done? So these are the 4 times. Remember this. These could be asked in the prelims. Now let's enter into the concept of a banking. The idea of a banking, let's start with the term bank itself. Whenever I use the term bank, please understand, earlier, right? Earlier, when we use the term bank, we generally refer to two activities. Bank is a financial institution which would perform two activities. One, collect deposits from the customers, mobilize deposits from the customers, and issue loans to the borrowers. Is it okay? Historically, when the concept of a bank emerged, they were performing only two functions. One, mobilize deposits and issue loans or advances. But over a period of time, understand this, over a period of time, the functions which are done by the bank have increased. I repeat, over a period of time, the functions which are conducted or done by the bank have increased. Right? For example, today the banks are involved in providing remittance services, that is a transfer of amount from one account to another account. They are also allowing the concept of gold loans. You can pledge a gold and take a loan from a bank. They also provide locker facility, right, etc. So over a period of time, the functions of the bank have kept on increasing. Now, what is the importance of this? Generally, the functions of the bank are divided into primary functions and secondary functions. Is it okay? The functions of the bank are divided into primary functions and secondary functions. Right? For example, primary functions, collection of deposits, right? Different types of bank accounts are there. Through that, they will collect the deposits. And issuing of loans. Both of them come under primary functions. And what about secondary functions? Gold loan, locker facility, transfer services or remittance services, value added services, insurance services, all of them basically come under the secondary services. Now, the importance of understanding this division is, in the newspaper, you will come across a term called as universal banks. Is it okay? You will come across a term called as universal banks. And in addition to this, you will also come across a term called as a differentiated bank. Is it okay? One is a universal bank and the second one is a differentiated banks. Universal banks will perform the primary functions as well as secondary functions. Is it okay? Universal banks will perform the primary functions as well as secondary functions. And when I say differentiated bank, these will perform very few of these particular functions. I repeat, universal, best example, SBI, ICICI, Punjab National Bank, the list will go on. These particular banks will not only perform the primary functions, will also perform secondary functions. But when I talk about differentiated banks, best example, payment bank, small finance bank, etc. These will not perform all of these particular functions. They will perform very few of these particular functions. Now, who will decide which function has to be performed by whom? It will be decided by RBI. Is it okay? Reserve Bank of India, because it is the regulator of the banking sector, will decide which type of a bank will perform which type of a function. And when they will call for the application itself, they will tell, right, the applicant what type of functions you will be allowed to do. For example, we will cover this in detail later. Have a look at this. In case of a payment bank, RBI, before issuing the license itself, will clarify that for a payment bank, no lending activities will be allowed. Is it okay? Right? The concept itself, when it is announced by RBI, RBI will tell very clearly, if you apply for the license of a payment bank, and if I give you the license, you can start a payment bank. But the feature of, one of the very important feature of a payment bank is what? You will not be allowed to issue loans in the market. So who is going to decide what functions are performed by the banks? It is decided by Reserve Bank of India. That is the regulator of the banking sector. Done? So have a look at this. The structure of the banking sector will be somewhat like this. One, we have scheduled commercial banks. We have regional rural banks. Some of the books will write regional rural banks within the scheduled banks. Right? I'll come to that. Give me a minute. Third one, we have a differentiated banks. For example, we have a payment bank, small finance bank. We also have a cooperative banks. Now start with the first pillar here, scheduled commercial bank. Now what is the meaning of the term scheduled here? Okay, what is the meaning of the term scheduled? In case of the scheduled, the concept is these are referred to as a scheduled for a simple reason. These are registered. These are registered under the second schedule of RBI Act of 1934. I'll repeat the statement here. These are referred to as a scheduled banks for a simple reason. These are registered under second schedule of RBI Act of 1934. And under the scheduled banks itself, you will have a commercial banks, you will also have a RRBs, you will also have a cooperative banks within the concept of scheduled itself. Okay. But the concept of a scheduled commercial bank again is divided into two parts. Idea of a scheduled commercial banks will have two pillars again. One, we have a public sector banks, and second, we have private sector bank. Within the public sector bank, have a look at this. There are two pillars again. That is, one is SBI, State Bank of India, and the second one is other, right, nationalized banks. Other nationalized banks. What is the meaning of nationalized banks? We'll understand it later. Please do not worry. Other nationalized banks. We have SBI. We also have nationalized banks. Now, please be very, very careful. The law regulating SBI is different, and the law which regulates nationalized banks are different. That is the reason I have given two pillars here. Second point, some of the books along with the SBI, some of the books along with the SBI will also use the term associate banks. I'll repeat it here. Along with the SBI, they will also use the term associate banks. Earlier, SBI was one entity and there were different associated banks of SBI. For example, we had a State Bank of Mysore, State Bank of Travancore, State Bank of Patiala, right, so on and so forth. But what has happened? Government of India in the last couple of years has taken these particular State Bank associates, merged that with SBI itself. Is it okay? I'll repeat it. The associates of the State Bank have been taken and has been merged with the State Bank of India itself. Right now, there are no associates. There are no different associates. All of these are part of SBI itself. Done? And in case of nationalized banks, right, the numbers are changing. Please do not worry about it. Idea for nationalized banks is Government of India in two rounds. Government of India in two rounds, 1969, 1980, nationalized or transferred the ownership of these particular banks. Done? Right? Again, why it was done, right? How many banks were covered, on what basis, right, these were covered, we will have a look at it later. But idea is the public sector banks have two pillars. One is SBI, State Bank of India, and the second one is other nationalized banks.